Hi everyone, my name is Sonu Singh and welcome to Investing Intel. आज के इस वीडियो में वी आर टॉकिंग अबाउट द Q2 numbers for financial year 25-26 as presented by Azad Engineering. So in its investor presentation, the company has only posted its standalone numbers. However, on its filing on the exchange, the company has given full consolidated numbers. So we'll quickly go through the standalone numbers, and the consolidated numbers for the company are on the same line, so we need not to discuss that in detail. So yeah, so for this financial year, Q2 FY26 versus Q2 of FY25, so on year basis the revenue for the company is up 28%, and which now stands at 143 crores. The EBITDA margin has been maintained at 36%, and it is up at 29% to 51.4 crores. The PBT is also maintained at 32.8%, and it is up 56.4% year on year to 46.8 crores now. The PAT margin for the company is very impressive at 23%, and it is up 56.6%, and now currently on year basis basically, and now it stands at 33 crores. So the key takeaways from the for the company is that the revenue is consistently up for the company, which is 30% approximately, okay, on year basis. And the PAT margin for the company is 23%, and EBITDA margin 36%. This is very important, because this company actually deals in the critical components, critical life saving components for basically aerospace, defense, and oil and gas and energy industry. So this basically gives Azad Engineering a advantage in terms of the pricing, because these components are very precise components, and sometimes it takes a lots of years of qualification process to to be able to qualify as a vendor to international companies. So for this reason, the company enjoys a healthy EBITDA margin because of the pricing power that the company has, and the PAT margin also quite impressive at 23.1%. So now we'll see the past history of the company. The company, what it does is okay. So this, if we see from FY21 to till FY25, the revenues are up at a CAGR of 39%. Okay, the EBITDA margin. So initially the EBITDA margin used to be around 31%, which now have improved to 36%. And the as per the commentary of the company's management, what they are saying is that they will be maintaining this EBITDA of 36%. Okay, so this EBITDA is up 44%. Are up at a CAGR of 44% in the last 5 years. And the profit margin, okay, it has improved from 11% to 19.5% in the last financial year, and it is up 60% CAGR from FY21 till FY25. So, and when we talk about the debt to equity ratio, as I mentioned, this is a capital intensive business. Okay, so it requires a lot of borrowing and all. So in FY24, the company launched its IPO. Okay, so this was the year when the company came with its IPO. Before that, the company was had significant borrowing in order to run the business. So in FY24, they brought the IPO. Okay, so from because of that, they they reduced their debt liability, and now they as presently it is it is a net cash company. So company has reduced its debt. Also in Feb 2025, the company brought its QIP for 700 crores. So they raised money from the market, so from the qualified institutions. So that was the QIP for 700 crores. So yeah, this is the basic introduction about the company. So yeah, going forward, what an investor needs to see is that this EBITDA margin will remain constant. Okay, it will not improve basically from here on, as per the management's guidance. So if the EBITDA margin is not improving, and the revenue growth target for the company for the next 3, 4, 5 years is that they will be maintaining a revenue growth of 25 to 30%. So this EBITDA, if it remains, the profit margin are likely to remain constant. Okay, so what profit growth we are seeing at 60%, in the future it will be only around 25 to 30% in the range of this. Okay, so that is what an investor needs to see if he is looking or she is looking for the company as a potential investment. And what also we need to see is that the company is maintaining ROC close to 20.7%. So that is a healthy ROC when compared when we are looking for capital intensive businesses. Now what also I needed to mention is that if we see yes, so this is the standalone profit and loss account. So for the when we see the revenue from operations, it is up 32.1% on year-on-year basis. And consumption is, if we see, so it is only up, it is only up around 10%. Okay, so while the revenue has been up 32% year on year, the consumption, that is the raw material cost. Okay, so this consumption cost has been up only 10%. However, there has been significant, this is 50% increase in the employee expenses, and other expenses are steadily up 30%. So if we see the reported EBITDA, it is up 37%. So there is a jump here. So यहाँ पे what we are seeing is the improvement in the EBITDA margin. Now what is happening with the company is that this raw material cost that the company procures the raw material for the manufacturing processes, so they have this is up only 10%. Okay, so in terms of sales, okay, in terms of revenue, the consumption or the raw material cost hasn't gone up much. Why? We'll see that later. The employee expenses, however, significantly up. It is up 50%, while the revenues are up only 32%. Now, what the company says is that the consumption expenses as a percent of sales has decreased from 14.9% in H125 to 12.3% as on H1 of FY26, largely due to better price negotiation and development of domestic supplies as compared to foreign vendors. So this raw material that the company was procuring, so now the company is looking for the localization of these raw materials. Okay, so what gives a company advantage by doing this is that the raw material cost is basically is lesser, and also the company can ensure better supply, and the delays which often happens due to international or foreign based suppliers, that can also be taken care of. The lead time basically decreases, and also the company has been able to do a better price negotiation with its vendors. And the employee expenses for the company is significantly up. Okay, so it is a 50% year on year. So why is that? And the increase in employee count due to expansion of new facilities. The company is coming with rapid expansion plan. So it has a rapid expansion plan. So because of that, the company has to onboard new employees. So because of that, the employee count or the employee expenses have gone up. Also the annual salary increments and the bonuses and the strengthening of the middle and senior management. So basically the company is onboarding new employees as well as usual salary increments and bonuses. Okay, so now, and also the depreciation cost, if you see, okay, this depreciation cost, now earlier it was 13 crores, now it is 20 crores. This is also 50%, which is due to because of capacity additions. So what are these capacity additions that we are going to see next? Now also there is other income, mainly due to increase in interest income from FDs, and the finance cost of the company is high due to additional loan that the company is borrowing to sustain the business growth. Okay, so now this additional capacities that we were talking about, currently till FY25, okay, it operated 4 facilities in Hyderabad with a combined area of 20,000 square meters. Okay, so the company is located in all its manufacturing facilities are located in Hyderabad. Now what is the future plan of the company is that multiple sub facilities it will be making function in the upcoming years. So this new project is basically, or the expansion plan has been categorized into 2 categories or in 2 phases, basically phase 1 and phase 2. The first phase will be its combined area will be 95,000 square meters, and in phase 2 there will be expansion plans for 67,000 square meters. If you combine these two, this is around 162,000 square meters. Okay, so this is basically 8x capacity expansion the company is planning for. So company का target क्या है? To expand its manufacturing capacity by 8x. Okay, so from here till here, so company's plan is for 8x capacity expansion. So currently 1x है, तो 8x और add करेगी, तो total capacity will be 9x. Okay, so because for this the company basically onboarding new employees, and also because of this the employee expenses is significantly up, as we can see in the P&L statement for the current quarter. So what are these facilities? The company has mentioned these facilities here. Okay, so these facilities are already the part of phase 1. So what company has done is that it has inaugurated in September 2025, this in the last month, it has inaugurated a lean manufacturing facility for Siemens Energy. Okay, and it has a total area of 7,200 square meters. And another lean facility, manufacturing facility, has been inaugurated for the GE Vernova at Hyderabad itself for a combined for a total area of 7,600 square meters, and this was inaugurated in April 2025. Likewise, in March 2025, the company inaugurated 7,200 square meters of lean manufacturing facility for I think this was Mitsubishi. For yes, this was for Mitsubishi. Okay, so yeah, this is basically the so if we combine these new facility, these are around 22,000 square meters. Okay, so in phase 1 square meters, in phase 1 was target was 95,000 square meters. So more such facilities will be coming in future. So basically what is happening for the company is that there are huge expansion plans for the company, and the company is aiming for 30% revenue growth, assuming that the as per the guidance of the management, the EBITDA margin will remain constant. So 36% EBITDA margin के साथ 30% EBITDA growth will be registered. Okay, and 30% profit growth can be expected. Okay, so with these parameters, now the investor has to analyze the company and do the their own analysis whether they find it as a better deal as an investment or not. Because what is happening is that the company is available at a PE of around 100. That is the problem basically. The PE that the company is available for is 100. Okay, so however this PE of 100 could be sustained. I mean, for if you see for a long term perspective, let's say 3-4 years, and if you see a 30% growth in the PAT, okay, or the EPS growth will not be basically 30%, because company will have to dilute the equity for raising funds. So if we assume 25% of EPS growth or 22% of EPS growth, okay, for the next 3-4 years, okay, and then equity dilution, and with equity dilution, okay, the EPS growth is 22-23%, 25% for the next 3-4 years. So at 25%, for the next 3 years, the EPS will double basically. The EPS will double. However, suppose if we are assuming that the final trailing or the terminal PE for the company is 70, and which is now 100, so effective share price increase will be only 40% from here in the next 3 years. Okay, so that has to be seen. So yeah, with this I've basically covered the quarterly numbers for the company. However, we can later discuss about in brief or in detail about the company's profile and what does the company do and what are their strengths and weaknesses. So yeah, with this I'll just wrap up this video here today. Thanks for staying till the very end. If you like the video, please consider subscribing the channel and leave your comments in the comment section below if you have any suggestions or query. With this, yeah, thank you, bye.